Welcome to Indianomics. Deepening India's bond markets has once again become a top priority for the government. It was the big discussion point in the first round of pre-budget meetings. With banks overexposed to infrastructure companies and weighed down by bad loans, bond markets are now seen as the only available source for funding future infrastructure projects. Yet, India's corporate bond market is negligible. It amounts to 10% of the GDP, while in Malaysia, the corporate bond market accounts for 40%, in Korea, 70%, all emerging markets. Last week, industry body FICCI convened a conference to discuss ways to deepen the corporate bond market, which I moderated. The speakers included the best of breed, RBI Deputy Governor HR Kant, Finance Ministry Joint Secretary Manoj Joshi, Stuart Milne of HSBC, Anshula Kant of SBI, Koushik Chatterjee of Tata Steel, Ramesh Subramaniam of Tata Power, and Pankaj Vaish of Citi. Since these are among the best minds on the subject, on Indianomics today, I bring you excerpts from that conference. Let's step into the conference at the point where RBI Deputy Governor Mr. Khan laid out the immediate steps underway to revitalize the bond markets.
In terms of what we should be doing going forward, I put it in my usual some framework of 7 I's. In terms of issuer, perhaps there is a need to more and more issuances. It has been facilitated, but it's not really happened. With the same ISN number, we have more issuances. And also, we have need to look at some of the new categories of issuers, including the municipalities. We know there is a huge requirement of the smart city funding, and we need that sort of issuer. And there are issues relating to municipal bond issuances, whether in terms of disclosure, user charges, escrowing the receivables. So this is another set of issuer which will come into play. In terms of investor class, we know, of course, this is that we have PFs and insurance companies, and how do we further incentivize them. There has been some action, but some more needs to be done. Probably this partial credit enhancement will facilitate because they will get credit enhanced. In terms of instruments, we have tried repo. We need to further work on that. Why it is not happening? One reason why it is not happening, because people have too much of GSEC and they can do it, and why get into that? And once there is a fiscal dominance comes down, probably that is one factor which will help corporate debt market well. And why the CDS is not working? One, of course, is the issue of netting, which we are working, and we will need to probably amend either Payment System Act and RBI Act. We are in active dialogue with the government. And when you talk about intermediaries, one issue which is always being talked about is market making. And who do the market making? Whether again banks should be doing market making, and again there comes back to the banking system. So we have allowed something to the PDs to do, but they have also their limitations. They don't have deep pockets, and they are other obligations. Whether the debenture trustees can be market makers, that is something which we should be looking at. And whether there can be an SPV, which with some quote-unquote sovereign support, which can do some sort of market making. And of course, the whole host of issues surrounding credit rating agencies, that they provide a very key element of the infrastructure. This came to a fore in the recent 1 or 2 cases. I don't want to take the name. How from casualty somebody goes to the mortuary without going through ICU and all that, and suddenly rate drops, and whether the charges was created, whether the Venkatesh trustee was sleeping, or the rating agency has done the due diligence. So do we need to look at the whole gamut of issues surrounding the rating arrangement? Two critical things, just to recapitulate. One is to see that this bankruptcy thing happens. And second, of course, we are on that right path of cutting down the fiscal dominance. The fiscal dominance comes down, which is on the track. There will be certainly incentive for people to investors to get into corporate debt.
So on ensuring that Indian bonds are part of global indices?
No, what we have right now, as you know, we have now laid down a framework for the government securities market for the next 2.5 years. We have put out a very predictable framework how it will go, and the end result should be we should reach close to 5% of our outstanding. And for the state development loan, which was not receiving any attention, at least 2%, we saw 3,500, for example, getting oversubscribed. So that is in terms of deepening and broadening and more investors coming in a predictable manner. and there is a bias for the long-term fellows. And we have, as I mentioned, we have now 40-year paper, and going forward, maybe over time we will consider really long-term, more than 20-year, 30-year paper, whether we can free totally out of any limit, but that is going forward. Right now, there is no pressing need for India to open up too fast, too much, and get into those flows, and then you have those problems. You know, every now and then we get sneezing and fever. What happens in Washington and what happens in Beijing. So I think we have to tread cautiously. And the point which you didn't ask, probably you could have asked, is when we are going to increase the 51 billion, because we have still some leeway available there, more than 20%. Going forward, we will see how much we need to do. But one thing probably we will be doing quickly in consultation with government is that, just like we have done for the GSEC, we will denominate in rupees, and whatever masala bonds are getting issued, they will be part of this, so we will adjust accordingly and see if there is a need to expand. But right now, there is no pressing need for getting into the global index.
If RBI lays the onus on the government to deliver a lower fiscal deficit and a bankruptcy code to create a good bond market, the Finance Ministry willingly came forward to accept the responsibility. Manoj Joshi, the Joint Secretary in the Ministry, spoke for the government.
From the government side, the focus primarily in the bond market side is, one is on the bankruptcy. Beyond AAA space and beyond quasi-sovereigns, if the corporate bond market is to evolve, the bankruptcy system has to be a working bankruptcy system. And that's one of the highest priority which government is focusing, and the Vishwanathan committee is in the final stages, and we hope immediately after that we will be able to go to the Parliament for enactment of the law and putting in place the system for it to work, because for the first time a comprehensive law is being planned, because earlier attempts were all bank-led in terms of bankruptcy. This time it's a much more comprehensive, focused on all creditors and focuses on the company's resolution. And we are putting a lot of focus on the administrative mechanism by which the bankruptcy enforcement could take place, because in Indian context, if it gets delayed, then the bankruptcy doesn't really take place. So that's the highest priority, because without which I don't think beyond top-rated bonds we would be able to move much. Second area of focus for government is, as I think everyone is aware, that you don't really have the pools of funds which could invest in bond market. We have very few players: banks, LIC and other insurance companies, EPFO and other provident funds, NPS, mutual funds, and FIIs. And these are the set of people who could invest. The investment horizon of mutual funds and FIIs is very, very short term, and they need liquidity, and if you need liquidity, to go beyond quasi-sovereigns is difficult. LIC and banks have demonstrated very good ability of going beyond this short-term horizon in both lending and investment in equity or corporate bonds with a much longer horizon, much better evaluation of projects. We have not seen that in Provident Fund, EPFO or NPS. I think they have focused mainly on whatever is the tested, something which is really working. Unlike other countries, as we have seen in the Canadian pension plan, these are also state-run pension plans, and they do a very smart investment, both in equity as well as in debt. So the focus needs to be on a smarter investment from the existing players. Right now, LIC also doesn't go beyond AA rated, and so that is one. And second, increasing the pool of available funds. Last year, budget, an attempt was made to increase the tax reduction available for NPS by another 50,000 rupees. I think we need to make pension plans much more tax efficient compared to plain investment in equity. Currently, because we do provide long-term capital gains exemption in equity market, I think compared to that, the tax efficiency of our pension products is at the same level. So we need to work on ease with which people could put money on in the pension plans, which is not happening.
Well, that's the policy makers. Key takeaways: 1, promise of an early bankruptcy code; 2, possibly more tax breaks for investments in pensions; 3, from the RBI, some relaxation of the 3-year residual maturity needed for foreign investment in corporate bonds; 4, in the medium term, taking out the 20 and 30-year, the long bonds from the FII limits; and 5, other work in progress rules for bond issuances by companies to which banks are already exposed through loans, better regulation of rating agencies, and international settlement. But what does industry and the markets want? That part of the discussion after the break.